Okay, the last of our 4 words, accrued revenue, right? So now this one's just like accrued expenses, only it is the other side. And this time instead of bringing in expenses, we're going to bring in any revenue that we've earned and might not have recorded, right? So here's just a for instance. Let's say we're a landscaper and we have a contract to go to work for someone, and we charge them $700 a month, right? And at the end of every month, last day of every month, I send them a bill, right? So what happens? It is December 1st, right, and December 31st, and the next month out would be what would be January 31st, right? Because this is also really essentially what, January 1st. We're doing this as of what, December 31st, right? So I'm out working, and I landscape, and I start on December 1st, and we do work all month long, right? All month long. Well, at the end of this month, right, as of December 31st, we have earned that money, right? But I haven't got it yet. I'm not going to get that money until next accounting period, so I have to accrue this revenue, right? I have to bring this revenue in. So last day of the accounting period, right, I do what? I do an entry to accrue that revenue. Accounts receivable, right? And fees earned. $700, right? So that represents what? That's the work that I did in December, the whole month of December, but I'm not going to get paid till later, right? But I have to do what? Accrue this revenue, because my income statement needs to show that we've earned that money, and we earned it when? During this accounting period, right? And our financial statements as of December 31st will also show that we're owed that money, right? That we're owed that money. So that's accrued revenue. That's one example. Another one we run into is interest sometimes, right? So we looked at interest expense last time. This time we're going to look at interest revenue, right? So we have a CD at the bank, right? We have a CD at the bank, and we invest that CD on November 1st, and it's a 90-day CD. So that's roughly, it's going to be about what, January 31st, right? That'd be about 3 months. Well, what happens at the end of the accounting period? We're earning interest, right? We have that money in the bank, and we're earning interest, and we start earning interest November 1st. We're going to earn all the way through to the end of the year, right? And we're going to have some interest earned, but we won't receive it yet. We're going to get paid that interest, right, when our CD matures, right? But as of the end of the accounting period, I have to do what? I have to accrue that revenue, right? So at the end of the accounting period, let's say that interest is going to be what, this period it's going to be $200, and this period is $100. I need to do what? Recognize the earning of that $200, right? Interest receivable and interest revenue, right, for $200. This right there is my adjusting journal entry, right? That is what I do at the end of the accounting period to bring my accounts up to date. So that shows that I've earned this revenue in this accounting period, right, even though I haven't got it yet. But it also shows that we are owed that, right? So that is, again, fairly briefly, but it's pretty straightforward, right? We're recognizing things that we haven't recognized, like work that we've done and not billed, and interest we've earned and not received, right? That's the kind of thing that we're doing with accrued revenue. So that's the deal. That's the deal there.